from LiLu's investment in Lukoil, a deep dive into a value play. Part 1. The Asymmetry of Chaos. Buying a dollar for a penny. Alright, here's the one idea that matters. The one idea that explains the entire trade. When the price is absurdly low, you don't need a perfect future. You just need reality to not end. That's the Lukoil story. At the time, LiLu is not some seasoned fund manager. He's in his early 20s. A student. This is pre-Himalaya capital. No outside investors. No leverage. No institutional backing. He's investing small amounts of personal capital money he's saved, recycled, compounded carefully, because that's all he has. That matters. When your capital base is small, you can't afford elegance. You can't afford consensus. You're hunting for asymmetry. He's at Columbia University, and he's already fully switched on to value investing. He famously walks into a Warren Buffett lecture, thinking it's a buffet food, not philosophy, and instead walks out obsessed with margin of safety and intrinsic value. He studies under Bruce Greenwald, the intellectual heir to Benjamin Graham, and absorbs the idea that price, not narrative, is where risk lives. Academically, he's an outlier even there. He becomes the first person at Columbia to graduate with 3 degrees simultaneously. Economics, law, business, all hard degrees. And all while staying in the living room with 8 other people and barely speaking any English, and just about 30 years of age. Not only that, but he used the float from his student loans to make his investments. That background matters because it explains how he can sit comfortably with legal uncertainty, financial chaos, and incomplete information, and still act. Because he's young and capital constrained, he's not looking for great businesses at fair prices. That comes later. Right now, he's looking for the opposite. Obvious, screaming mispricings, cigar butts, situations where price has completely detached from reality. And then the world breaks in a way that perfectly matches his skill set. Soviet Union collapses. An entire command economy disappears almost overnight. Prices are unanchored. Inflation explodes over 2,500% at the peak. Savings vaporize. Wages lag reality by months. People stop planning years ahead and start planning days ahead. After the collapse of the Soviet Union, Russia undertook shock therapy economic reforms, rapidly moving to a free market system. In 1994, the government privatized thousands of state-owned companies via a nationwide voucher program. Every Russian citizen received vouchers that could be exchanged for shares in formerly state-run businesses, including prime assets like oil giant Lukoil and gas monopoly Gazprom. However, the process was so abrupt and unfamiliar that most people didn't understand what the vouchers or shares really meant. Ordinary workers and citizens, grappling with hyperinflation and economic chaos, were happy to swap these paper certificates for immediate cash, something tangible they recognized. As LiLu later recounted, somebody could come along with real cash, and they freely gave away. As a result, these assets were trading at extraordinarily low prices. The macroeconomic backdrop in early 1990s Russia was extremely turbulent. The country experienced hyperinflation, prices rose over 2,500% in 1992, and a collapse of its financial system, leaving many enterprises nearly bankrupt. To local citizens, shares in companies like Lukoil seemed virtually worthless. Owning them was viewed as a burden rather than a benefit, since Soviet-era companies carried heavy social obligations to employees. In contrast, a few contrarian investors, LiLu among them, saw a once-in-a-lifetime opportunity. Russia was one of the world's largest holders of oil and gas reserves, and history had shown that great nations' industries can recover with time. The voucher privatization meant pieces of these resource-rich companies were essentially up for grabs to anyone with the foresight and nerve to participate in the chaotic auctions. This isn't theory, it's survival math. And into that chaos, the Russian government launches voucher privatization. Every citizen receives a voucher paper certificates representing claims on former state assets. Factories, mines, steel plants, and oil companies. Real productive assets. One of the largest ownership transfers in history. On paper, it's revolutionary. In practice, it's chaos. There is no mature stock exchange, no culture of equity ownership, no trust in institutions. Trading happens over the counter, informally, often face-to-face. Physical certificates change hands in street markets or through primitive brokers. To someone living through hyperinflation, A voucher isn't ownership, it's confusion, it's risk. It's something you can convert into food, rent, or vodka today. So people sell, immediately, cheap. This is forced selling, not because the assets are bad, but because the sellers cannot afford patience. That's where the price signal breaks. That's where LiLu sees the gap. LiLu's analysis of Lukoil exemplified classic value investing at its best. He realized the stock's market price bore almost no resemblance to the company's underlying worth. How cheap was Lukoil? By LiLu's own account, forget about earnings, just look at assets. At the time, oil was averaging about $20 a barrel, yet Lukoil's share price implied a valuation of only 10 cents, 20 cents per barrel of oil reserves. In other words, Lukoil's shares were trading for as low as 1 cent on the dollar of asset value, sometimes even half a cent on the dollar in extreme cases. It was ridiculous, LiLu later said of these prices. This meant investors could buy into one of the world's largest oil companies at a 99% discount to its book value. Such an extraordinary gap between price and intrinsic value was a neon-flashing signal of a high margin of safety investment. Even Gazprom, the gas giant, was available at similar giveaway prices, and LiLu saw the opportunity during this period. Crucially, the information to recognize this mispricing was available at the time to those who looked. LiLu and a handful of intrepid investors noted the oil reserves and assets these companies held. Lukoil alone had billions of barrels of reserves, and performed simple arithmetic against the token share prices. The Soviet-era financials may not have been easy to obtain, but basic data on reserves and production was known. By comparing the implied cost per barrel of reserves to prevailing oil prices, LiLu saw an enormous discrepancy. He also understood the context. Russian citizens were selling because they valued immediate cash amidst economic hardship far more than a distant claim on corporate assets. This informational asymmetry, where locals underestimated the value while informed outsiders saw the bigger picture, created the perfect setup for market inefficiency. LiLu essentially had insight that the market price was wrong, grounded in both data, asset values, and history. His study of past economic recoveries, for example, post-war Germany and Japan, likely gave him confidence that Russia's companies could eventually normalize. In short, what LiLu saw in Lukoil was a dollar trading for a penny, due to temporary chaos and ignorance in the market. He doesn't start with a story about Russian reform. He starts with balance sheets and hard assets. Oil is global. Oil is priced in dollars. Oil doesn't care about Russian politics or domestic inflation. A barrel in Siberia is still a barrel on the world market. That's why oil had to be the focal point. Hard assets with global pricing neutralize local chaos. So he looks across Russian oil broadly, Lukoil, Yukois, others, but Lukoil stands out as the cleanest expression, one of the largest integrated oil companies on the planet, formed from major Soviet entities sitting on enormous proven reserves in Western Siberia. And he does not build a sophisticated model. He does arithmetic. What are the proven reserves? What is oil selling for globally? What price is the market assigning to those reserves? The answer is insane. Russian oil reserves are being valued at roughly 10 cents, 20 cents per barrel, sometimes even less, while oil itself trades around $15, $20 per barrel. That's not cheap. That's a dollar for a penny. So the question isn't why buy, it's why is it priced this way? The oil is real. The reserves are real. Soviet reserve data, especially for proven fields, was historically conservative and technically rigorous. The problem isn't the asset. It's the seller. The sellers don't think like owners. They're trading long-duration claims on future wealth for immediate certainty today. This isn't a functioning market. It's a liquidation. Now here's where LiLu's mindset matters. He sees every risk clearly. Political risk, rule of law risk. Custody risk, do I actually own this? Nationalization risk, corruption risk, currency risk. He assumes almost nothing and trusts nothing on faith. He does the work mapping ownership structures, figuring out how foreigners can buy indirectly through brokers, vouchers, or physical certificates, and navigating ownership caps, registrars, and legal gray zones. And because the risks are real, he demands something extreme in return. A 99% margin of safety. He's saying he doesn't need to understand Russia perfectly, doesn't need reforms to succeed, doesn't need clean governance. He needs the entry price to be so low that even if he's wrong about half the story, there's no permanent loss. That's pure Graham. Buy at 1 cent on the dollar, and the world has to end, or the asset has to be fully confiscated for you to lose permanently. So he acts, not cautiously or experimentally, but as much as his limited personal capital allows, he leans in. He accepts friction physical certificates, OTC chaos, illiquidity, travel, discomfort, because there is no clean brokerage experience here, and that friction is the moat. The harder it is to execute, the fewer competitors remain. The trade doesn't resolve cleanly. Prices swing violently. Volatility is extreme. And then in 1998, Russia defaults, the ruble collapses by roughly 90%, panic returns, and most investors quit. Executing Russian equity trades in the early 1990s wasn't clicking a button. It was a logistical operation in a Wild West system. While he never disclosed the exact broker, the mechanics were clear. Through voucher auctions, investors bought vouchers on the secondary market, often with cash, and tendered them for shares. If few people bid, the shares per voucher ratio was high, driving the effective price down. Before a formal exchange existed, trading happened over the counter, with intermediaries matching buyers and sellers, and often physically exchanging cash for share registry extracts. In some cases, agents went directly to company towns to buy shares from workers who had received them during privatization and were desperate for cash, selling for fractions of intrinsic value. The biggest risk was custody. Share registries were often physical ledgers held at company headquarters or by third-party registrars that could be bribed. There were real stories of names being erased or registrars disappearing. One company stood apart: Lukoil. Under Alec Purov's push for Western legitimacy, it centralized and professionalized its registry faster than peers, and by hiring Bank of New York for its ADR program in 1995-1996, it effectively outsourced trust, giving foreign investors protection local holders lacked. System wouldn't exist until late 1995. Financials followed Soviet accounting focused on production quotas, ignoring economic depreciation, failing to consolidate subsidiaries. Profit was political, not economic. EBITDA, free cash flow, and GAAP simply didn't exist in practice. For Western institutions, the environment was uninvestable under any prudent man standard. For someone steeped in Graham, the absence of structure and information was the opportunity. The market wasn't just inefficient, it barely existed. Prices were set by the desperation of sellers dumping vouchers they didn't value, not by discounted cash flows. Here's the punchline. Even after a sovereign default and a 90% currency collapse, early voucher buyers were still up roughly 10x. The trade worked through disaster because the entry price was that absurd. That is margin of safety as physics. So what's the real lesson? It's not buy emerging markets. It's not Russia was misunderstood. It's this. When humans are forced to sell and price detaches from reality, the investor with patience and arithmetic gets paid. LiLu wasn't predicting a perfect Russia. He wasn't forecasting stability. He was betting on something simpler. Oil is real. Reserves are real. And the market price was temporarily insane. Time is the mechanism that eventually pulls price back toward value. That's the whole game. You don't win by being the smartest person in the room. You win by being rational when the room is irrational, and by paying a price that makes the future forgiving. This is Avi. Like and subscribe. On to the next. From LiLu's investment in Lukoil, a deep dive into a value play. Part 2. LiLu. From Tiananmen Square refugee to value investor. Now let's talk about the person at the center of this, because without understanding LiLu, the Lukoil trade doesn't make sense. At this point in his life, LiLu is not the LiLu people quote today, the long-term owner of a small number of extraordinary businesses. He hasn't earned that evolution yet. He's still in the phase where capital is scarce and opportunity has to be asymmetric, or it's not worth touching. He's a student at Columbia, recently arrived in the U.S., a political refugee. No safety net, no brand, no access. What he does have is time, intensity, and an unusually high tolerance for discomfort and uncertainty. That matters, because most investors don't actually lose money because they can't do math. They lose money because they can't sit with uncertainty. They can't operate when there's no social proof, no clean data, no familiar rules. LiLu grew up without those things. He survived chaos long before he tried to price it. When he encounters value investing, it clicks immediately, but not in the Buffett as celebrity way. It clicks in the Benjamin Graham sense. Balance sheets. Assets. Paying so little that your downside is mathematically limited even if the world behaves badly. So when he looks at markets, he's not asking, is this a wonderful business? He's asking, is this so cheap that reality itself is on my side? And that's why Russia shows up on his radar. Not because it's exciting, not because it's fashionable, but because it's broken. Seeing the blatant undervaluation, LiLu acted decisively. He literally traveled to Russia during the mid-1990s to take part in the voucher auctions and to purchase shares of Lukoil and other companies directly. At the time, Russia had no well-developed stock exchange for these new equities. Buying in meant dealing with physical share certificates or vouchers in improvised auctions and street markets. This was not a passive button-click investment. It required on-the-ground hustle. LiLu's willingness to go the distance, geographically and intellectually, gave him an edge in accessing the opportunity. Sure, you had to buy the physical certificates from their holders. There was no stock exchange to speak of at the time, he noted of the process. In essence, LiLu was cashing out Russian voucher holders at a tiny fraction of true value, a move that took both conviction and courage. The environment was unstable, and there was always a risk the bet could go wrong. Political upheaval, asset nationalization, etc. What tipped the scales for LiLu was the massive margin of safety inherent in the price. Buying at approximately 1% of intrinsic value meant that even if his valuation was off by a wide mark, or if adverse events occurred, there was a huge cushion. As he later observed, those extreme discounts were so forgiving that even a near catastrophe wouldn't wipe out the investment's potential. This is vividly illustrated by what happened a few years later. In 1998, Russia defaulted on its debt and the ruble currency collapsed by roughly 90%, an economic disaster that devastated many investors. Yet, those who had bought that certificates 5 years previously were still up tenfold on their investment, despite the 1998 crisis. In other words, even with Russia's worst-case scenario unfolding, early Lukoil investors like LiLu were still sitting on gains of around plus 900%. In dollar terms, how's that for a margin of safety? This outcome was not luck alone, it was a direct result of paying so little that nearly all the downside was buffered. LiLu's decision to buy Lukoil was grounded in a probabilistic mindset. He recognized that when you pay 1 cent for a dollar's worth of oil assets, the odds are dramatically in your favor. Another key aspect of Li's mindset was independent thinking. While the crowd, in this case most Russians and even many Western investors, either ignored these opportunities or deemed them too risky, LiLu trusted his own analysis. He did not let prevailing pessimism or the strangeness of the market deter him. Instead, he leaned on fundamental facts, e.g., barrels in the ground, global energy demand, replacement cost of assets, and made an unorthodox bet. This exemplified the classic value investor's trait of going against popular sentiment when prices and fundamentals diverge widely. LiLu later emphasized that such opportunities arise when market prices detach from business reality due to fear or informational gaps, and that one must be willing to act when others won't. In the Lukoil play, he came to the conclusion to buy because all indicators of intrinsic worth, hard assets and future earnings power, pointed to values many times greater than the ask price, giving him confidence to load up despite the chaos. LiLu understands something most people miss. The best opportunities don't come from optimism, they come from dislocation, from systems that are changing faster than human psychology can process. Russia in the early 1990s is exactly that. An entire ownership structure is being rewritten. People who never thought like owners are suddenly handed claims on real assets, and they don't want them. They want certainty, they want cash. They want now. LiLu sees this not as a moral story or a geopolitical story, but as a behavioral one. Forced sellers don't set rational prices, and when sellers are forced, the buyer with patience controls the terms. This is also where his personal history matters more than spreadsheets. Someone who has lived through regime change doesn't assume that chaos means assets stop working. Factories still run, oil still pumps, humans still trade. He's already internalized that systems can be unstable, while underlying economic reality persists. So when he looks at Russia, he doesn't ask, is this safe? He asks, how cheap does this have to be for safety to stop mattering? That's the frame. And it leads him directly to assets, not stories, to things that exist independent of politics. Oil, reserves, physical production. This is not courage. It's logic applied without emotional filters. Most people can't do that because they anchor to headlines, reputations, and social consensus. LiLu anchors to arithmetic and survival logic. That's the foundation. Before Lukoil, before the vouchers, before the returns. The mindset comes first. Because once you understand how he thinks at this stage, scarcity, margin of safety, indifference to noise, the trade almost becomes inevitable. He wasn't looking for Russia. He was looking for something absurdly mispriced. Russia just happened to be where the absurdity was. LiLu's contrarian investment in Lukoil during 1994-1995 paid off enormously. As the Russian economy stabilized and foreign capital poured in, Lukoil's share price surged towards a more rational valuation. Early investors who bought during the voucher privatization saw gains on the order of 10x within just a few years. Even in nominal terms, measured in rubles, which depreciated significantly, Lukoil turned into a 100-bagger for those who held on through the 1990s. LiLu was able to compound his initial stake multiple times over, illustrating the power of patient, long-term holding during a recovery. Importantly, he did not trade in and out for quick flips. He understood that the real payoff required waiting until the market eventually recognized the intrinsic value that had been there all along. By exploiting this temporary market inefficiency and then simply being patient, LiLu let the undervaluation unwind naturally over time. His experience with Lukoil crystallized several core investing lessons that would guide him thereafter. Margin of safety is paramount. The Lukoil investment had an almost absurdly large margin of safety. LiLu was effectively buying assets at a 99% discount. This cushion protected him when unforeseen events, like Russia's 1998 crash, occurred, proving that buying at a steep discount to intrinsic value limits downside risk. Ever since, LiLu has insisted on investing only when he has a substantial margin of safety. Independent, contrarian thinking. LiLu's success came from seeing value where others saw nothing. Locals thought the shares were worthless burdens, and many investors were scared off by political risk. LiLu, however, did his own homework and trusted his analysis of Lukoil's true worth. This taught him that markets can be extremely inefficient in times of upheaval, and that independent research and conviction are rewarded. Information and diligence. Gaining an edge required extra effort. Traveling to Russia, sourcing information on companies' assets, and navigating an immature market. LiLu learned that on-the-ground research and information arbitrage can uncover opportunities that are invisible to less diligent investors. He famously advocates for accurate and complete information in investing, a principle born from these early experiences. Long-term perspective. Rather than being deterred by short-term volatility or the lack of immediate liquidity, LiLu took a long view. He was investing in the post-Soviet future of these companies, not the present turmoil. By holding through volatility, he allowed fundamentals to eventually shine through. This patience validated the view that the market is a weighing machine in the long run. Given enough time, price and value tend to converge, especially when one buys so far below true value. In retrospect, LiLu's Lukoil play was a masterclass in value investing under extreme conditions. He leveraged a unique historical moment, the privatization of an empire, and applied timeless principles to it. The result was not only a phenomenal financial return, but also a formative learning experience. LiLu saw firsthand how irrational pricing plus disciplined analysis equals profit, reinforcing his faith in value investing. The chaotic Russian market of the mid-90s taught him more than any textbook. It proved that one could find $1 for 1 cent if one looked in the right places and stayed rational when everyone else panicked. These lessons influenced LiLu's later investments, from Asian equity bargains to BYD in China, and solidified his reputation as an investor who fishes where the fish are, i.e., in markets or situations rife with inefficiency and fear. This is Avi. Like and subscribe. On to the next. From LiLu's investment in Lukoil, a deep dive into a value play. Part 3, Russia breaks, shock therapy, chaos, and forced sellers. So what exactly happened in Russia that caused this? To understand why Russia gave its economy away for free, You have to look at the streets of Moscow in 1992. The Soviet Union has just collapsed. The superpower is gone. The reality on the ground is apocalyptic. The supply chains are broken. The grocery store shelves are completely empty, and the government has just unleashed shock therapy, lifting price controls overnight. Inflation hits 2,500%. The reformers, led by Anatoly Chubais, are terrified. They believe they have a window of maybe 6 months before the Communist Party regroups, stages a coup, and drags the country back to the past. They have to dismantle the Soviet state economy. And they have to do it fast. The problem? The empty pockets. They want to privatize the factories, sell them to the people. But there is a massive problem. No one has any money. Decades of communism meant no private wealth. The hyperinflation of 1992 wiped out whatever savings people had left. You can't sell a factory to a population with zero cash. If they auction the factories for real money, the only buyers will be the mafia or foreign investors. Both options would start a civil war. The solution? The voucher. So, the government invents a new currency. They print 144 million vouchers, one for every man, woman, and child in Russia. The deal is simple. You take this voucher to an auction, and you trade it for shares in a company. You become a stakeholder in capitalism. The goal isn't fairness. The goal isn't to get a good price for the assets. The goal is irreversibility. They need to create 144 million private owners overnight so that the communists can never take the property back. The vodka valuation. This is where the plan meets the brutal reality of poverty. The government hands a voucher with a face value of 10,000 rubles to a grandmother in Siberia. To the government, that voucher represents a share of a nickel mine or an oil rig. But to the grandmother, it's just a piece of paper. She doesn't know what a dividend is. She doesn't know what equity is. She knows she is hungry. She knows her grandson needs shoes. She walks out of the bank, and standing right there on the corner is a man with a sign. He isn't offering stock advice. He's offering cash, or a bottle of vodka, or a bag of sugar. This created a machine designed to misprice assets. The desperate population sold their vouchers on the street for the price of survival, maybe $10 or $20 USD. The savvy operators, the future oligarchs, the red directors, and the hustlers bought them by the thousands. They bought the voucher for the price of a bottle of vodka, and they used it to buy shares in companies that were worth millions. So, Russia doesn't slowly reform. It snaps. Early 90s, the Soviet Union collapses, and what replaces it isn't a market, it's a vacuum. Overnight, price controls disappear. Subsidies vanish. Money stops meaning what people thought it meant. Inflation explodes. Not 5%, not 20, thousands. Prices don't rise, they detonate. Savings built over entire lifetimes vanish in months. Salaries trail reality by weeks, sometimes days. Pensioners are wiped out. Nobody trusts numbers anymore because numbers don't sit still long enough to mean anything. This is what shock therapy actually looks like on the ground. After the Soviet Union collapses in 1991, Russia tries to jump straight into capitalism with no transition and no institutional scaffolding. The state distributes vouchers to nearly every citizen in 1992-1993 paper certificates, nominally worth 10,000 rubles each. In theory, these vouchers represent ownership in the country's industrial core: oil, gas, metals, factories. In practice, almost no one understands what they own. Hyperinflation peaks above 2,500% in 1992. Cash today buys food. Cash next week is meaningless. So people sell. Not because they've done analysis, because they're trying to survive. Vouchers get exchanged for vodka, groceries, bus fare, $10, $20, sometimes less. There is no real stock exchange yet. No screens, no liquidity, no trust. Trading happens over the counter, informally, often on the street. Physical certificates change hands in chaos. Underneath all of this, the assets are very real. Oil fields, pipelines, refineries. Lukoil, formed in 1991 from 3 major Soviet oil entities and corporatized in 1993, rapidly becomes one of the largest integrated oil companies in Russia. The reserves are not a mystery. Soviet-era geological surveys are detailed and reliable for proven fields. Global oil prices are observable, roughly $15 to $20 per barrel through the early to mid-1990s. International press covers the privatization process in real time. None of the core facts are hidden. What's broken is the price. Russian oil reserves are trading at 10 to 20 cents per barrel, sometimes as low as 5 cents in moments of panic. In global markets, comparable reserves trade closer to $5 to $7 per barrel, even without assigning value to future exploration, production growth, or refining margins. On balance sheet terms, shares acquired through vouchers or early OTC trading imply valuations of half a cent to 1 cent per dollar of asset value, roughly a 99% discount to intrinsic worth if you value only proven reserves and ignore everything else. LiLu later describes this gap bluntly. "I paid 1 cent on the dollar," he says. In another talk, he adds, "It was ridiculous. I thought at that point that's some kind of a margin of safety, even considering the political situation in Russia." He doesn't observe this from afar. He goes there, mid-1990s Russia. He travels in person to participate in voucher auctions and to buy shares of Lukoil directly. There is no passive execution here. As he explains, you had to buy the physical certificates from their holders. There was no stock exchange to speak of at the time. This means handling paper, navigating unreliable intermediaries, accepting illiquidity, legal ambiguity, and real political risk. But the arithmetic overwhelms the uncertainty. From publicly available reserve data, observable oil prices, and reported voucher trading prices, the conclusion is inescapable. Even if half the story is wrong, the downside is limited. As LiLu puts it, the discount was so absurd that even if something went terribly wrong, you still had protection. He isn't forecasting reform. He isn't betting on stability. He's buying assets so cheaply that disaster is already priced in. Then, disaster actually arrives. In 1998, Russia defaults on its debt. The ruble collapses by roughly 90%. It's a financial catastrophe. Many investors are wiped out entirely. And yet, LiLu points out a fact that still sounds implausible. Those who bought the certificates 5 years earlier were still up tenfold on their investment. After a sovereign default, after a currency collapse, early buyers at 0.5 to 1% of value are still sitting on gains of roughly 10x in dollar terms. That experience crystallizes the lessons. First, margin of safety is not theoretical. It's survival. Buying at a 99% discount buffers you against outcomes that would otherwise be fatal. As LiLu later emphasizes, if you buy something at 1 cent on the dollar, the world has to end for you to lose permanently. Second, independent thinking matters most when markets feel uninvestable. Locals view the shares as worthless burdens. Western investors dismiss the opportunity as too risky. LiLu trusts arithmetic over sentiment. The market wasn't inefficient, he later reflects. It basically didn't exist. Third, information and diligence create edge. He's willing to travel, to gather primary information, to understand assets on the ground. He later summarizes this principle simply. You need accurate and complete information. That's where advantage comes from. Fourth, time favors value when price and reality are violently disconnected. He isn't deterred by volatility or illiquidity. He's investing in the eventual weighing of assets, not the current panic. As he frames it, in the short run, markets are emotional. In the long run, they reflect reality. In hindsight, the Lukoil investment becomes a masterclass in value investing under extreme conditions. It isn't about predicting Russia's future or trusting political outcomes. It's about recognizing when fear has severed price from fundamentals and acting with discipline. LiLu later describes this period as formative, not because it was unique, but because it proved something timeless. When prices detach completely from reality, you don't need optimism. You just need courage and math. That lesson carries forward, from Russia to later investments across Asia, and eventually to companies like BYD. He learns where to fish, in markets saturated with fear, friction, and misunderstanding. Places where $1 can still be bought for 1 cent, if you're willing to stay rational when everyone else panics. The theory says, free prices will create efficient markets. Reality says, people panic. Factories keep running, oil keeps pumping, electricity keeps flowing, but the social contract breaks. And when that happens, People don't behave like rational economic agents. They behave like survivors. The government under Boris Yeltsin decides speed matters more than precision. They want to make capitalism irreversible, so they push privatization through fast, before the political window closes. And this is where the forced selling begins. Every citizen is handed a voucher. In theory, it's ownership, a claim on the future productivity of the country. In practice, it's abstract, confusing, and useless in the present moment. If you're trying to buy food this week, a future claim on an oil company doesn't help you. So people sell. Not because they've analyzed value, not because they've discounted cash flows, because they need cash now. This is the soil the Lukoil trade grows out of. Not brilliance, not prediction, but forced selling on a national scale. This is Avi. Like and subscribe. On to the next. From LiLu's investment in Lukoil, a deep dive into a value play. Part 4, the voucher machine. How ownership was given away. Here's where the mispricing becomes mechanical, because once you understand the voucher system, you realize this wasn't just panic. It was a machine designed to misprice assets. The Russian government doesn't privatize carefully. They don't sell companies to the highest bidder. They distribute ownership to everyone equally, indiscriminately, and fast. Every citizen gets a voucher, one piece of paper, supposedly worth the same for everyone, supposedly representing a slice of the country's productive assets. In theory, this is democratic capitalism. In reality, it's chaos. Most people have never owned equity. They don't know what a share is. They don't know what an oil company is worth. They don't know what to do with a claim on future cash flows when the present is collapsing. So the voucher isn't seen as an asset, it's seen as a nuisance. Something abstract, something uncertain, something that can't be eaten or burned or exchanged for rent. And because the vouchers are bearer instruments, whoever holds them owns them. They immediately become tradable on the street. No screens, no brokers, no liquidity pools, just people with paper and people with cash. The supply is enormous. Tens of millions of vouchers flood the market at the same time. The demand? Almost non-existent. Not because the assets are bad, but because the buyers who could value them don't exist locally yet. There's no investing culture, no institutional capital, no long-term mindset. So the clearing price collapses. Vouchers trade for the equivalent of a few dollars, sometimes less, sometimes for goods instead of money. And this is the crucial point. The price of the voucher has nothing to do with the value of what it can buy. It's set by desperation and confusion, not appraisal. The mechanism that converted this state wealth into tradable equity, and therefore accessible to investors like LiLu, was the Voucher Privatization Program, VPP, launched in October 1992. Designed by Anatoly Chubais and the State Committee for State Property Management, GKI, the program aimed to transfer ownership of state enterprises to the private sector rapidly. The primary goal was political, to create a class of private property owners so quickly that a return to communism would be impossible. Every Russian citizen, including minors, received a privatization voucher with a nominal face value of 10,000 rubles. These vouchers were bearer instruments, meaning they could be bought, sold, or traded freely on the secondary market. They served as the currency for voucher auctions, where equity stakes in state-owned enterprises, SOEs, were sold to the public. The distribution was massive in scale. Approximately 144 million vouchers were issued to a population of roughly 148 million. The 10,000 ruble face value was purely nominal. In the hyperinflationary environment of late 1992 and 1993, the market value of the voucher fluctuated wildly, trading on street corners and exchanges for anywhere between $4 and $20. The pivotal insight for deep value investors lay in the behavior of the voucher recipients. For the average Russian citizen, struggling to survive food shortages and the collapse of the social safety net, a piece of paper promising future ownership in a factory was abstract and functionally worthless compared to immediate consumption needs. Vouchers were sold en masse on street corners for bottles of vodka, sacks of potatoes, or small amounts of cash. This mass liquidation by the populace created a supply glut that depressed the price of the vouchers well below the intrinsic value of the assets they could purchase. Consolidators, often operating in gray markets, purchased these vouchers for as little as $4 to $12, bundling them to bid for large blocks of shares in voucher auctions. Because the supply of vouchers was fixed and the number of enterprises to be privatized was vast, over 15,000 medium and large enterprises, the implied valuation of the entire Russian industrial base was absurdly low. As the data in Table 1 illustrates, the market capitalization of the entire privatized Russian economy, including giants like Gazprom, Lukoil, and Norilsk Nickel, was valued by the voucher market at roughly $3 billion to $12 billion. This figure was smaller than the market capitalization of a single mid-sized American utility company or a single Western oil major like Texaco. This disconnect was the foundational thesis for LiLu. You didn't need to be rich or connected to get a voucher. Every Russian citizen was issued one by the state as a physical paper certificate during privatization, usually distributed through workplaces or local offices. Once you had it, it was literally a bearer instrument. You could sell it for cash on the street, hand it to a middleman, or take it yourself to a voucher auction or investment fund. Physically, that meant showing up with the paper voucher, submitting it to an auction or fund in exchange for shares, often via crude paperwork and registries, and receiving a claim on equity in a real company like Lukoil. Most people didn't understand or trust that process, needed cash immediately, and dumped the voucher. The few who did understand simply aggregated thousands of these pieces of paper and converted them into ownership of industrial assets at prices that made no economic sense. So, each voucher can be exchanged for shares in companies like Lukoil, real companies, producing companies, global commodity companies. But the market doesn't price that. It prices the voucher. And when vouchers are dumped en masse by people who don't want them, the implied valuation of the entire Russian industrial base implodes. This is how you end up with one of the largest oil producers on Earth being valued at less than a mid-sized American utility. Not because anyone ran the numbers and decided that was fair, but because the ownership distribution mechanism severed price from value. The system created a one-time, non-repeatable imbalance. Millions of forced sellers, no informed buyers, physical friction-heavy trading, zero institutional support, extreme time pressure on the sellers. That combination is lethal to price integrity. And LiLu understands something subtle here. This isn't a bad market. It's a non-market. Prices aren't signals. They're symptoms. Symptoms of fear, of urgency, of cognitive overload. So when he looks at voucher prices, he doesn't treat them as information about value. He treats them as evidence of dysfunction. And dysfunction, when it's this large and this structural, is exactly where deep value lives. The voucher machine didn't just give ownership away. It guaranteed that ownership would land in the hands of people who didn't want it and then be sold to the few who understood what it really represented. That's not luck. That's design colliding with human behavior. And when those two collide at scale, the result is what LiLu was waiting for. Assets priced not by what they are worth, but by how badly someone wants to get rid of them. This is Avi. Like and subscribe. On to the next. From LiLu's investment in Lukoil, a deep dive into a value play. Part 5. Lukoil as an asset, not a stock. LiLu isn't looking at Lukoil as a ticker. He's looking at it the way you'd look at land, or a pipeline, or a mine. Strip away the headlines, strip away the politics. What's left? Oil in the ground. Wells that produce? Infrastructure that already exists. A company that moves barrels from reservoir to refinery to export terminal. That's the asset. And this distinction matters, because in broken markets, stocks lie. Prices scream. Volatility distracts. Narratives dominate. But assets are quieter. They just sit there doing what they do. Lukoil controls enormous reserves in Western Siberia. These aren't speculative fields. They're known, mapped, producing oil that had been drilled, measured, and pumped for decades under the Soviet system. While the macro environment provided the opportunity, the specific selection of Lukoil demonstrated LiLu's ability to distinguish quality within a distressed asset class. Not all Russian vouchers were equal. Many represented ownership in obsolete manufacturing plants or enterprises stripped by red directors. Lukoil was different. Lukoil was formed in 1991, just prior to the Soviet collapse, from the merger of three major oil and gas production associations in Western Siberia: Langapasneftgaz, Ureneftgaz, hence the acronym LUK, along with several refineries. Unlike Gazprom, which held a statutory monopoly on gas and was viewed as a state within a state, Lukoil was one of several vertically integrated oil companies, or VIOCs, created by the government. By Decree No. 1403 in November 1992, Lukoil was transformed into an open joint stock company in April 1993. This legal restructuring was the prerequisite for its privatization. While the state retained a controlling stake initially, significant equity was distributed to workers and sold via voucher auctions. The physical reality of Lukoil's assets stood in stark contrast to its market valuation. Reserves. In the mid-1990s, Lukoil controlled proven hydrocarbon reserves that rivaled those of global supermajors like Exxon or Royal Dutch Shell. Estimates placed these reserves in the range of 10 to 15 billion barrels of oil equivalent, though audited figures would later confirm even higher amounts. Production. The company was responsible for a significant percentage of Russia's total oil output, pumping over 1 million barrels per day. Vertical integration. Unlike many fragmented post-Soviet entities that only controlled extraction or refining, Lukoil controlled the entire value chain, from extraction in western Siberia to refining in Perm and Volgograd, and retail distribution. This allowed it to capture margins at every stage and, crucially, gave it access to export markets. Vagit Alikperov, a former Soviet deputy minister of the oil industry, was the architect of Lukoil. Unlike the oligarchs who would later acquire assets through the rigged loans for shares auctions, like Khodorkovsky or Berezovsky, Alikperov was an industrialist. His strategy was to model Lukoil after Western majors like BP or Eni. In 1994, Lukoil became the first Russian company to begin trading on the nascent secondary market and hired KPMG for auditing, signaling a seriousness about transparency that was rare in Russia at the time. By 1995, Lukoil had secured a strategic partnership with ARCO, Atlantic Richfield Company, which purchased a stake in the company, a massive vote of confidence from a Western major that validated the asset quality. For LiLu, these qualitative factors, a management team oriented toward Western capital markets, early adoption of auditing standards, and a consolidated corporate structure provided a layer of safety that pure cigarette butt stocks lacked. He was buying a high-quality business at a liquidation price. This isn't a venture bet. This is replacement cost logic. If you wanted to recreate Lukoil from scratch, find the oil, drill the wells, build the pipelines, train the workforce, you'd need tens of billions of dollars and years of execution. But the market isn't pricing that. It's pricing fear. So LiLu ignores earnings. He ignores quarterly numbers. He ignores management forecasts. None of that matters in this moment. What matters is this: the oil exists, and the world needs it. Oil is a global commodity. It doesn't care where it comes from. It's priced in dollars. It moves across borders. It clears internationally. That single fact collapses a lot of the risk people obsess over. The ruble can collapse. Politics can swing. Accounting can be messy. But if oil is coming out of the ground, it will find a buyer. And here's another layer most people miss. Costs are local, revenues are global. Lukoil pays wages, electricity, services, and rubles, but it sells oil at global prices. When the local currency weakens, the economics improve at the asset level. This isn't theory, it's mechanics. So when LiLu looks at Lukoil, he's not asking, is this a well-run public company? He's asking, what is the implied price per barrel I'm being offered? And the answer is absurd. He's being offered oil reserves for pennies on the dollar, sometimes fractions of a penny. That's not a forecasting problem. That's a measurement problem. If the reserves are real, and they are, then the price is wrong. Everything else becomes secondary. Yes, there's governance risk. Yes, there's political risk. Yes, there's theft risk. But those risks are bounded when the entry price is this low. This is the core insight. When you buy assets at a liquidation-style price, you don't need perfection. You need survival. Lukoil doesn't need to become Exxon. It doesn't need Western standards overnight. It doesn't need pristine shareholder protections. It just needs to keep pumping oil. And it does. That's why LiLu treats Lukoil as an asset first and a stock second. Because in moments of systemic stress, stocks are claims people dump. Assets are realities the world continues to use. And when the gap between those two gets wide enough, the investor who focuses on the asset, not the ticker, ends up owning something real at a price that makes time work for him. That's the Lukoil decision. Not a bet on Russia, a purchase of oil mispriced by chaos. This is Avi. Like and subscribe. On to the next. From LiLu's investment in Lukoil, a deep dive into a value play. Part 6. The Math That Mattered. Cents per barrel versus reality. This is where the whole thing collapses into one number. Not a model, not a narrative, a ratio. LiLu doesn't ask what Lukoil will earn next year. He doesn't care about 5-year forecasts or terminal values. In this environment, those are fake precision. He asks a simpler question. What am I paying per barrel of oil in the ground? That's it. Because oil is already priced by the world. Every day. In dollars. With brutal transparency. At the time, oil is trading around $20 a barrel. That's the reality price. The price at which buyers and sellers around the globe agree oil is worth today. Now he looks at Lukoil's implied valuation through the voucher system and early trading. The core of LiLu's thesis was a quantitative comparison that revealed a pricing disparity so extreme it rendered standard valuation models irrelevant. In his lectures at Columbia Business School, LiLu has repeatedly cited the cents per barrel metric as the primary heuristic for this investment. In the early 1990s, the global price of crude oil fluctuated between $15 and $20 per barrel. Western oil companies were typically valued by the equity market at approximately $5.00 to $13.00 per barrel of proven reserves. This valuation reflected the market's confidence in their ability to extract, refine, and sell that oil at a profit, as well as the safety of their property rights. In contrast, during the voucher privatization and the immediate post-privatization period from 1993 to 1995, Russian oil companies like Lukoil traded at implied valuations of 5 cents to 20 cents per barrel of proven reserves. This is what's shown in the table. This table compares how oil and gas reserves were valued in the early to mid-1990s across Russian producers and Western supermajors, highlighting an extreme valuation gap. Despite Lukoil holding reserves comparable to Exxon and Royal Dutch Shell, 10 to 15 billion barrels, it traded at just 1 cent 20 cents per barrel versus $8, $13 per barrel in the US and Europe, implying a market cap of only approximately 50 cents, $2 billion compared to approximately $80, $100 billion for Western peers. Gazprom was even more deeply discounted, often trading at fractions of a cent per barrel of oil equivalent due to state control and gas-heavy reserves. The table illustrates the core anomaly LiLu exploited. Identical physical assets priced orders of magnitude apart, squarely fitting a Benjamin Graham balance sheet, deep value framework where assets traded far below liquidation value. This table quantifies the extreme scale of the mispricing machine by comparing Russian energy giants to their Western peers during the 1993-1995 privatization window. It shows that, while companies like Lukoil and Exxon possessed roughly similar physical oil reserves, 15 billion barrels, the market valued them at vastly different levels. Western markets priced Exxon's oil at $8.00 to $13.00 per barrel, whereas the chaotic Russian voucher market priced Lukoil's oil at mere pennies, 1 cent 20 cents, and Gazprom's massive reserves at fractions of a cent. This discrepancy reveals that Russian industrial assets were effectively sold for roughly 1% of their global fair market value, creating a massive arbitrage opportunity for the few insiders who recognized that the vodka valuation of these vouchers would eventually align with global reality. LiLu recalled the math vividly in his Columbia lecture that he gave. The 5-year average for oil prices was about $20 per barrel, and on a per-share basis, they were trading for as low as 1 cent on the dollar. So, about 10 cents to 20 cents per barrel of crude oil. This valuation falls squarely into the Benjamin Graham methodology of buying assets below their liquidation value. LiLu explicitly described his approach at this time as looking for value primarily on the balance sheet in the classic style of Benjamin Graham, looking for a cigarette butt. The logic was as follows. Intrinsic value floor. Even if the Russian economy remained dysfunctional, the oil itself had a global market value. If Lukoil could export even a fraction of its reserves, the cash flow would dwarf the entry price. The asset was dollar-denominated, global oil price, while the equity was ruble-denominated, local chaos. Asset protection. In a scenario of hyperinflation, hard assets, oil, retain value, while currency debases. Buying oil reserves for pennies was effectively an inflation hedge. Margin of safety, at 10 cents per barrel, the price could drop 50% or 80%, and the thesis would not break because the underlying asset was worth 50x or 100x the purchase price. The gap between price and value was so vast that it absorbed almost any operational error or external shock. Even if oil prices dropped to $10/barrel, which they did in 1998, the spread between the 10 cents valuation and the $10.00 commodity price was still 100. 1. The break-even for the investment required an apocalypse that destroyed the utility of oil itself, not just a recession. This is the essence of a deep margin of safety. LiLu held the position through the mid to late 90s. This period saw a massive run-up in asset prices. The Russian stock market was the best-performing market in the world in 1996 and 1997, driven by the re-election of Boris Yeltsin, defeating the communist candidate Zyuganov, and the influx of foreign portfolio investment. By 1997, Lukoil's market capitalization had surged. The stock, which might have been acquired at a split-adjusted equivalent of pennies, was trading at significantly higher multiples as the Russian boom took hold. The RTS index went from 100 in 1995 to nearly 600 in late 1997. And the answer comes back insane. The market is valuing Lukoil's reserves at something like 10 to 20 cents per barrel. In some cases, even lower. Read that again. 10 cents versus $20. This isn't a rounding error. This isn't optimism versus pessimism. This is a 2 orders of magnitude disconnect. It means you're buying oil at about 1% of its global price, sometimes 0.5%. At that point, almost nothing else matters. Political risk? Okay, discount it. Corruption? Discount it. Inefficiency? Discount it. Even theft? Fine. Discount it too. You can be wrong about a lot and still make money when the gap is this wide. That's what margin of safety actually means in practice. Not a vague feeling of comfort, but arithmetic that forgives error. Here's the key insight. This price is not saying oil is worth 10 cents. It's saying sellers don't care what oil is worth. They care about cash today. So the market price isn't a judgment on the asset. It's a reflection of human urgency. And LiLu understands that urgency expires. People calm down. Systems stabilize. Time passes. Assets reassert their utility. When that happens, prices don't need to go to fair value for the investment to work. They just need to stop being insane. If 10 cents becomes $1, that's a 10-bagger. If it becomes $2, that's 20. You don't need perfection. You need normalization. And here's the subtle part. Oil companies are leveraged to normalization. Once the panic fades, the valuation framework changes. Investors stop asking, will this survive, and start asking, what is this worth? That shift alone reprices the asset dramatically. So LiLu isn't forecasting oil prices. He's arbitraging valuation frameworks. He's buying in a world where assets are priced like scrap and holding until they're priced like businesses again. That's why this trade works even through disaster. Later, when Russia defaults and the currency collapses, people are shocked by how well early buyers still do. But they shouldn't be. If you bought oil at 1% of value, a 90% currency collapse doesn't kill you. The math already did the work. This is the kind of investing most people never get to do. Not because it's complex, but because it requires sitting inside a number that looks too stupid to be real. Cents per barrel. That was the signal. Everything else was noise. This is Avi. Like and subscribe. On to the next. From LiLu's investment in Lukoil, a deep dive into a value play. Part 7. Information Asymmetry. What LiLu knew that others missed. Let's be clear about something up front. The edge here isn't secret information. It's interpretation. LiLu didn't have access to some hidden document or inside tip. The reserves were public. Oil prices were public. The voucher system was visible to anyone who bothered to look. Everything that mattered was technically knowable. What was missing wasn't information. It was synthesis. Most people in that market weren't even asking the same questions. The local sellers, ordinary Russian citizens, weren't thinking in dollars per barrel. They were thinking in meals per week, inflation per month, how to get through Friday. To them, a voucher wasn't an abstract claim on future cash flows. It was a confusing piece of paper in a collapsing economy. On the other side, Western investors were asking a completely different set of questions. Is there rule of law? Is custody clean? Are the financials audited? Is management incentivized correctly? All reasonable questions. All irrelevant at this price. LiLu stripped it down to one narrow, brutal question. Is the price so wrong that the risks don't matter? And the answer was yes. This is where real information asymmetry lives. Not in hidden facts, but in the willingness to reason differently. LiLu understood that the sellers didn't know what they owned, not because they were stupid, but because ownership itself was new. Abstract, untested. They had no lived experience with equity as a claim on future production, so they undervalued it. At the same time, Western investors overvalued their own checklists. They mistook uncertainty for uninvestability. They demanded standards that only exist in mature systems, and by doing so, they excluded themselves from the only environments where prices can become truly absurd. LiLu sat in between. He didn't need perfect information. He needed enough. Enough to know the reserves were real. Enough to know oil clears globally. Enough to know panic doesn't last forever. That's it. He wasn't trying to solve Russia. He was solving one imbalance: forced sellers meeting absent buyers. And here's the subtle asymmetry most people miss. The locals were price takers. The institutions were spectators. That left a vacuum. And in that vacuum, a small determined buyer who understood asset value could set the terms. That's why the opportunity existed at all. If Russian citizens had time, education, and stability, vouchers wouldn't have traded at these prices. If Western capital could move freely and safely, prices wouldn't have stayed this low. But neither was true. So price detached from value. LiLu also understood history. He'd seen what happens after wars, revolutions, and collapses. Not everything survives, but productive assets usually do. Especially assets the rest of the world needs. Oil doesn't care who governs Moscow. So what LiLu knew wasn't a secret. He knew panic creates bad prices. He knew forced sellers distort markets. He knew assets outlast regimes. He knew time corrects extreme dislocations. Most people understand these ideas intellectually. Very few are willing to act on them when the environment feels completely uninvestable. That's the asymmetry. Not better data, better nerve, better framing, and the discipline to trust arithmetic over consensus. And in markets like this, that's enough to change your life. Now, here's the real test of the thesis. And it didn't come during the boom. It came during the bust. In August 1998, Russia defaulted on its domestic debt and devalued the ruble. The currency lost more than 70% of its value in weeks. The stock market collapsed. From peak to trough, equities fell around 90%. By conventional wisdom, that kind of collapse should wipe out foreign investors. But LiLu pointed out something most people missed. Entry price matters more than headlines. He explained it simply. If you bought something at 10 cents that was worth $0.50% of intrinsic value, even a 90% currency collapse doesn't kill you. You still come out ahead. In fact, you might still be up 10 times your money. Think about the math. You buy at 1 cent on the dollar. The price explodes during the boom. Then it crashes 80%. You're still massively ahead. That's not luck. That's structure. The initial undervaluation was so extreme that it absorbed macro catastrophe. And because oil is priced in dollars, Lukoil's revenues were effectively hard currency, while its costs, labor, electricity, were paid in devalued rubles. Long-term, the devaluation actually improved the economics of Russian oil exporters, even if stock prices temporarily imploded. This is why LiLu could sit through chaos while others panicked. He wasn't anchored to price, he was anchored to value. The trade also revealed deeper lessons. The highest alpha often lives in places institutions refuse to touch. Markets labeled uninvestable are precisely where reputational and custodial risk get mispriced relative to fundamental asset value. Liquidity, something investors claim to love, was the enemy of price discovery here. The friction, confusion, and illiquidity of the voucher system were the reason prices got so stupid in the first place. And philosophically, this investment marked LiLu's transition. It was his pure Benjamin Graham phase buying assets purely because they were cheap. But Lukoil wasn't just cheap, it was good. Real reserves, real production, real scale. That realization likely shaped his later evolution toward owning quality businesses with long runways, not just statistical bargains. At the deepest level, this trade shows what real information asymmetry looks like in transitional markets. It's not spreadsheets, it's behavior. It's watching who's selling, why they're selling, and who isn't allowed or willing to buy. LiLu wasn't betting on Russia stabilizing. He was exploiting a temporary breakdown between price and reality. And that's the enduring lesson. True margin of safety doesn't come from calm environments. It comes from buying something real at a price so low that even disaster can't break the math. This is Avi. Like and subscribe. On to the next. From LiLu's investment in Lukoil, a deep dive into a value play. Part 8. Lessons, incentives, fear, and extreme mispricing. Let's step back and strip this to first principles. The lessons from Lukoil aren't really about Russia. They're about what happens when systems fail and human behavior gets compressed under pressure. When systems break, incentives dominate intelligence. The Russian citizens selling vouchers weren't irrational. They were responding correctly to their environment. Their goal wasn't long-term optimization. Their goal was survival. Food, heat, certainty. When incentives shift from maximize future value to reduce uncertainty right now, prices detach from intrinsic value. Not slowly, instantly. Markets don't fail because people are stupid. They fail because people are constrained. Fear collapses time horizons. In normal markets, people think in years. Under stress, they think in days, sometimes hours. Voucher sellers weren't discounting future cash flows. They were discounting time itself. When time horizons collapse, long-duration assets get annihilated in price. Oil reserves are the longest duration assets you can own. That's why the mispricing was so extreme. Extreme mispricing doesn't come from bad news. It comes from structural dysfunction. This wasn't a recession or a weak earnings cycle. It was a regime collapse plus a broken ownership mechanism. Those conditions are rare. When they occur, prices don't drift, they snap. That's why cents on the dollar opportunities don't appear every cycle. They appear when systems change faster than human behavior can adapt. Margin of safety is arithmetic, not comfort. LiLu wasn't calm because he felt confident. He was calm because the math allowed him to be wrong. Buying at 1% of value means you don't need optimism. You don't need political reform. You don't even need competence. You need the asset to continue existing. That's a very low bar. Friction created the return. The custody risk, the illiquidity, the lack of transparency, those weren't obstacles. They were the source of the opportunity. If the market had been clean and accessible, the price wouldn't have been absurd. Mispricing lives where the process breaks down. The hardest part wasn't seeing value. It was trusting it when it felt irresponsible. In real time, this trade felt wrong, morally unstable, politically dangerous, financially chaotic. That's why it worked. Prices reflected fear and incentives, not reality. When fear dominates incentives, prices tell you more about psychology than assets. When that gap gets wide enough, arithmetic wins. Everything collapses into one idea. When the price is absurd, time stops being your enemy. Most investors fight time. They need growth quickly. They need narratives to stay intact. They need markets to cooperate. That's what happens when you pay a fair price, or an optimistic one. LiLu paid a price so low that time became the catalyst. He didn't need Russia to work. He didn't need reform. He didn't need good governance. He needed the world to keep using oil. That was always true. Here's the inversion most people miss. When you buy at the wrong price, time increases risk. When you buy at the right price, time removes it. As days pass, panic fades. As years pass, systems normalize. As decades pass, assets assert their utility. No prediction required, only survival. Now the uncomfortable question. Did LiLu sell too soon? If he entered around 1994 at roughly 15 cents equivalent and held through the full commodity supercycle, the math becomes absurd. Lukoil ADRs eventually traded north of $60. That's hundreds of times the original capital. Even selling early in the low 30s would still be a 200x return. But holding isn't free. LiLu launched his fund in 1997. Almost immediately, Asia collapsed. Then Russia defaulted. Lukoil fell over 70%. A personal account can tolerate that. A fund with outside capital often can't. Liquidity needs change behavior. Reputation matters. Optionality matters. Capital is path-dependent. There's also opportunity cost. He needed capital to move on to cleaner, more durable compounding machines. And he did. After Russia, he went on to make extraordinary bets in stable systems, most notably Timberland, where mispricing came not from chaos, but from short-term thinking about a long-lived brand. That shift mattered. This is where the Nick's sleep idea collides with reality. The idea is simple: own great businesses for a very long time and let them compound. But that requires stable capital, patient partners, and freedom from forced decisions. LiLu in the late 1990s didn't have that luxury. He was still earning the right to be patient. Selling earlier may look suboptimal on a spreadsheet, but selling allowed him to survive, to scale, and to reposition from pure Graham-style deep value into quality compounding later. In that sense, Lukoil didn't just generate returns. It funded the next phase, the phase where long holding periods actually become possible. That matters. The deeper lesson isn't never sell, it's understand what you're optimizing for. Maximum IRR, maximum absolute dollars, maximum long-term optionality. They're not the same. Lukoil wasn't about bravery or genius. It was about refusing to pay a price that demanded optimism. It was about letting arithmetic do the heavy lifting until time could take over. You don't get paid for intelligence in markets like this. You get paid for patience, earned by price discipline. When the price is merely cheap, things must go right. When the price is absurd, things just must not end. That's when time works for you. Not as a slogan, as physics, slowly, quietly, turning chaos into compounding. This is Avi. Like and subscribe. On to the next.